everybody. Thanks very much to the ASX for the opportunity. As mentioned, we're going to be discussing Aussie equities and specifically, how we approach the asset class. We're going to take a step back as well. There's a lot of talk these days within the ETF world specifically around factor investing, smart beta investing, and there are a number of different ways, like I say, to access what is a very traditional domestic market, which you are all very familiar with. So, it is quite important to take a bit of a step back. So I'm going to talk about ETFs in general, have a few slides on that. We'll try and run through those reasonably quickly. I'm not sure, if you do have any questions on that, happy to come back to that in the Q&A, and then maybe focus a little bit more time on the actual sort of methodology, what the broad benchmark looks like, and how VanEck has chosen to approach this. So just a little bit about VanEck. I'm not sure if you're all familiar with us. We're a global investment manager, been managing money since 1955. US headquartered. We do have some unlisted active strategies in the US, but the ETF business was launched around 13 years ago. And in terms of assets, we now have around 45 billion Aussie dollar equivalent in that ETF business. 60 of those funds are listed in the US. But we have 16 now listed on the ASX and have been in Australia for around 5 years. So as I said, we're going to touch on sort of what are ETFs. I think it's very important, to take the holistic view in terms of, like I said, that whole smart beta factor question. ETFs have been growing, as you all know, and it's very important to understand kind of how they work. So what is an ETF? Again, if there are any questions on this, if I go through too quickly, please come back to it in the Q&A. If we start on the right-hand side, it is just a fund. I was chatting to someone in the foyer earlier. These are structured in the same way as your traditional unlisted active managers. They are trusts, they are open-ended. The only difference is they traded on the ASX. So it really is just sort of an access question and how you execute or invest in an ETF that differs from the unlisted funds that you are quite familiar with. And what it does allow is, I guess, the blending of the best of both worlds. The unlisted funds do give you good diversification. You're not having sort of exposure to single stock risk if you want something quite diversified, but they do trade as any stock does on exchange throughout the day. How you transact sort of with us as the manager does differ a little bit. So this is, I guess, your traditional framework. You will fill out a form or go through M-Funds, and you are literally asking sort of the fund manager for some units in the fund in exchange for your cash. With ETFs, because the ASX provides the platform, there is that intermediary sort of, step in the middle. What that does help with is liquidity. So, buyers and sellers can transact with each other on exchange. But in the green box there, you'll see there are market makers. So these are organizations, their job is to provide liquidity. They will always be on screen, on the buy side and the sell side. So you don't have to find another buyer or seller to transact with. The market makers will always be there to give you the liquidity that you need to transact. I won't dwell too much on this slide, but again, just a couple of differences to sort of highlight. The holdings in ETFs are disclosed daily. So transparency is a very key benefit, that people quite like. You can go onto the VanEck website every day. We have an Excel spreadsheet there. You can download it. You can see exactly what we are holding on your behalf in the sort of custody account. Whereas with unlisted funds, that's monthly, quarterly, top 10 in alphabetical order. You don't quite get the look through that you do with ETFs. And management costs as well. Obviously, that's been a key driver of passive investment generally, and ETFs as a portion of that. So So globally, like I said, ETFs have been growing exponentially almost over the last sort of 5-10 years. And there are a couple of reasons for that. I think obviously the GFC gave everybody quite a fright. There was far more focus on fees, and people wanted to know exactly what they were getting in terms of value for money. And we have seen, I guess, the active-passive split change quite a bit since then. $5 trillion in assets now under management in the ETF world, with over 7,000 ETPs. So that includes active exchange-listed funds as well as passive, and I'll touch a little bit on that as we sort of move through. But as you can see, I mean, very strong growth over the last 10, 15 years. Australia, off a very low base compared to the global landscape, has actually probably been growing faster in percentage terms. We're around 38 billion Aussie dollars at the moment in terms of the whole ETF market. And just to sort of put that in a bit of perspective, the largest ETF in the US, the SPDR ETF, is around 300 billion in its own right. So, although you'll hear percentage figures and growth figures that sound pretty impressive, and they are, you must sort of appreciate it's coming off quite a low base as well. So we still have a long way to go in terms of market share. A few little tips on the trading of ETFs as well. Obviously, these things, like I say, you are executing on exchange through sort of your broker or your brokerage account. Just to make sure you do get best execution, just take note of those two little rules there. Don't buy in the first 15 minutes. Obviously, as you know, the ASX opens alphabetically, and because these funds are diversified baskets or portfolios, if you have a fund that has ANZ and Westpac in there, Westpac's only going to open at sort of 10:15, and the market makers, if they don't know what price Westpac is going to open at, they're going to push their spreads a little bit wider in that sort of 10 o'clock to 10:15 window, just until they have absolute clarity on what the underlying basket is worth. So once all the individual stocks are open, you'll see sort of the ETF baskets spreads come right in. Again, you will have seen screens like that, I'm sure, if you have bought or sold individual shares. With an ETF, it's exactly the same. You just go into your brokerage account, you put your ticker in, you're going to see something like that with prices on both sides and volume on both sides. So you know exactly what you're getting in terms of that execution. Just a little nuance as well, NAV versus last price. Obviously, when you get to the end of the day, individual shares, close at a certain price. And that is generally sort of the last traded price. Well, it is the last traded price through the auction. With ETFs, because it's a basket, at the end of the day, that basket is valued. But if that ETF is only traded last at sort of 2 o'clock, that last price can be a little bit different from the NAV. But all it is a timing issue. The value of the fund is the value of the fund, and that is the NAV. Again, another little, I guess, nuance to be quite aware of, with the proliferation of products in the exchange-traded space, it is key to understand some differences. ETFs, and we as an ETF provider are quite sort of passionate about this. Our index tracking vehicles, you're seeing a lot more of the active fund managers list their strategies now. That we would say is an exchange-traded product or managed fund, as the ASX sort of delineates. So you get these ETFs, which are the index tracking, ETPs, which could have some sort of derivatives in them, whether you're accessing commodity markets or something like that, and then the ET sort of MFs as well. So not everything that is listed is an ETF. Like I say, just be very clear that you do some reading and do some research and understand, the strategy, the methodology, whether it tracks an index, and so forth. And a few other things to look at, is the portfolio a basket of physically held securities, which, like I say, VanEck as an ETF manager, we hold all of the underlying. Not so much in Australia, but a lot in Europe. You do see ETFs with synthetic derivative exposures. It's not necessarily a bad thing. It can help with tracking error. They do just behave differently and bring in things like counterparty risk. So you've just got to understand, again, exactly what it is you're buying and how the ETF manager chooses to track that index. So now this is, I guess, the crux of it, just for the sort of final 5 minutes of the chat. You've decided you want to invest in Aussie equities. There are a range of different vehicles. You start looking at an ETF, and you find 3 or 4 different ETFs that give you Aussie equity exposure. Now, these are all going to give you a slightly different approach at what I say is a very traditional, well-understood asset class. There's obviously quite a domestic sort of bias in Australia. When we talk about factors as well, it's often better to talk about it in a global context, and I'll come on to that in a second as well. But it has been this evolution in indexing and methodologies that has helped bring access to these, like I say, smart beta type strategies to you, where in the good old days you had a broad market cap weighted benchmark, and that has now evolved into many different ways to weight the holdings of the underlying portfolio. So we would say smart beta is anything that deviates from market cap weighted. There has been a fair amount of comment around the term smart beta, strategic beta, alternative beta. They all are reasonably interchangeable. This seems to be the one that has stuck. But you don't have to be really complex or really sophisticated to deviate from market cap. You could just cap a single stock in your portfolio 10%. You're going to get a different outcome. You're not giving sort of all of your money to the largest company. So, you are altering, like I say, your portfolio exposure. And where this lands, it has created a middle ground in its own right. So obviously on the left is your traditional broad cap-weighted benchmarks, passive, low cost. You are buying the whole market. And then on the right, traditional active managed funds. What Smart Beta tries to do is blend both. Use some of the techniques that active managers have been using for a very long time, wrap those up in an index, and deliver them to you in a transparent, accessible vehicle, such as an ETF, at a very low cost. And again, we've talked about the ETF market in general. This just shows you that Smart Beta is kind of mirroring that growth in a global sense as well. Same for Australia. There are a number of different types of indexes. I've touched on a few. Obviously, at the top is sort of an ASX 200, 300 All Ords that most of you will be familiar with. I think the key is to understand when those indices were created, which was some time ago, and why they were created. A lot of them, were published in newspapers to give people an idea of, what the market has done. They're a barometer. It's your opportunity set as an investor. They don't necessarily make, the best investment sort of strategies or vehicles. So if you look, this is sort of taken from a bit of a global perspective and just shows how factors behave in different market cycles, and obviously lists through a couple of those factors: equal weight, momentum, risk-weighted, quality. These are all terms that you probably have heard and will be hearing more of. I think the key in a factor sense is to understand that Australia is quite a narrow market, only 3% of global equities. A lot of these strategies tend to work better when you have a larger universe to work from, global equities. In Australian equities, if you try and focus in on something specific, you can get a lot of unintended sector biases as well. Obviously, post-GFC, rates fell. Everybody knows, what happened to those stocks that exhibited good yield. They ran really hard, and we all know what's sort of happening to those at the moment with royal commissions and Julia mentioned sort of risks on the horizon with sort of housing, banking, and so forth. So, these factors do, go in cycles, particularly where you're looking at a market that's quite narrow. So, again, 4 questions we like to sort of ask. What are you targeting in terms of your index or your outcome? Is it backed up by academic research? Is it easy to understand? And is it true to label? So the ASX 200, ticks all of those boxes. Like I said, what are you targeting? You are just targeting the market. Have the banks gone up today? It's all in all likelihood, the ASX 200 has gone up today. It's really sort of, quite broad and dominated by that top 10. So what we at VanEck have done to access Aussie equities is trying to address the concentration risk. So the red lines there, you'll see the ASX 200, a lot of weight in that top 10, 12 stocks, quite a long tail. The blue lines is our Australian equal weight portfolio. So what do? We try and capture 90% of the investable market, which gives you around 84 stocks. And then we equally weight those. So you can see you're getting a far more diversified exposure to the domestic market. And again, looking at those 4 questions, what are you targeting? You are targeting diversification. Is now the best time to be putting all of your money in the top 10 in the financial sector? Potentially not. From a risk perspective, it may make sense to look to be a bit more diversified. And there's academic research, some overseas, some by CSIRO and Monash, domestically, that does look at these alternative weighting methodologies and how they perform. And obviously you get, very different sector exposure. You dial that financials chart right back there. So just to sort of wrap up, obviously, very important to look right through to the index methodology with all of these sort of exchange-traded products, whether they're ETFs, ETPs, managed funds, trusts, LICs. Just understand what they are trying to achieve and how they are trying to achieve it. And if you do that, you can really give yourself a few more options in terms of accessing some of these asset classes. Thank you.